bit.ly/growconfvc. So a lot of the articles and a lot of the commentary that we're going to be talking about is in there. And so let's actually talk about it. 3 years of Grow Conference. Jeff, I think you've actually been here all 3 years. Dave?
Yep.
2?
I think all 3.
All 3? Okay. First timer.
First
All right.
timer.
Very much like the crowd here.
I'm a virgin.
And in this short time,
Feels
we've
good,
seen,
though.
yeah, but we've seen a whole massive shift in the venture world as well. So this time is actually kind of paired up with stuff. I mean, even the fact that we're here. And Dave, a little while ago, you actually last week you posted something on the evolution of venture. I'd love you to kind of top line that, and then we'll unpack that throughout the conversation. And then one other thing, for those people who are actually watching on YouTube or streaming, you might want to put the headphones on. There may be some NSFW kind of activity here, but just wanted to put that warning out there in advance.
Fuck yeah!
Thanks for breaking the seal. It's done.
I was first.
All right, so Dave, do you want to start us off with kind of the top line of that, where you're seeing venture going?
Yeah, so I guess the trends that I think I was trying to observe was, one, there's been definitely a significant reduction in professional VC over the last 5 years or so. In particular, sort of this move to either very large funds, which you see from maybe Andreessen Horowitz, Excel, Sequoia, Benchmark, Bessemer.
Thanks, Dave.
Are you guys more than $1 billion or not?
We are.
You are more than $1 billion. Okay, all right. And then more seed funds, which are kind of in the maybe 50 to 150 range, which I think Jeff SoftTech is a great example of, Felicis Ventures, several others. First round probably used to be in that category, is now maybe moved out of that category, but they're also probably exemplary of that trend. So folks like, yeah, so I mean, I think starting in 2004, 2005, folks like Jeff and Josh Koppelman started doing a lot more aggressive investing at the seed level, particularly consumer commerce and some, small B2B. And that became quite a bit in vogue. I think a lot of other people copied that strategy. Next most recent trend was sort of like the rebirth of incubators, even though no one likes to use the word. So primarily with Paul Graham starting in 2005 and Techstars soon after, and then a bunch of other folks. Well, not right around 2005, 2006, because it was still sort of seen as out of fashion, but by 2008, 9, certainly started to be.
So in addition to the incubators, we're even seeing micro incubators that are actually filling a very specific void. You talked about, venture used to be about money and your network and your connections and your advice, right? And now there's a few things that you had noted in your article about the evolution from financial, basically classic bankers to operators, and non-investment headcount as part of the structure as well, which was interesting. So I'll ask all three of you, and I'll actually start with you, Ethan. What do you bring to your investments outside of the dollars, networks, connections, and advice?
Well, so outside of everything we bring to our investments, what else?
He's really
No, I mean, I just outlined a number of those things. So the Andreessen Horowitz folks are doing a great job of structuring things like recruitment, HR, biz dev, things that could be problematic for founders in the seed stage.
I mean, I think what you're getting with a traditional venture capital firm has evolved a lot. I mean, I think Dave talked about what's happening kind of broadly in the industry.
Yep.
And what's happening in our section of it is the same kind of thing, is this evolution that's going on. And I think the reason you're seeing folks like the firms Dave mentioned, Bessemer, raising these large funds, is because we can't no longer go to LPs and say there's one strategy we're going to apply. And we're going to raise this many dollars for this particular strategy, and we're going to invest that fund for 5 years. And that's what we're going to do.
Why can't you do that?
And the reason is because things change too fast.
Yeah.
You go to them with one particular strategy, we're going to invest in this particular market or this particular type of deal or this particular stage. Things move too fast. You may not want to do that 6 months later.
You think that's changed in the last 3 years, you're saying?
I think things, the pace of change has sped up. And so what we've said, and what a lot of funds have said is, look, we've adapted ourselves over the years. Our first fund in 1981, what we told LPs then and what we do now is very, very different.
Yeah.
we're just going to try to stay ahead of these curves. We're going to tell you what we're going to do as we're doing it, but we're not going to be locked into any particular strategy. Now, you asked, what do we bring to our investments? I think that's the same. I mean, I think that is not where the evolution is happening. We bring a lot of experience having taken a product idea and turned it into a company. And that's a nuance that a lot of people don't understand when they think about the evolution in the financing landscape. They think about it's really cheap to build product, and that's true. You can build it for free. I mean, there were dozens of examples that the last speaker just gave of that. But turning it into a company still costs money in most cases.
Yep.
And building the infrastructure around turning it into a company, that takes money and that takes expertise.
So you guys have IP around that. So when you're sitting on a board, do you bring the full weight of that IP, or do you bring your specific knowledge and POV?
I don't think Bessemer's any different because when you work with Bessemer, you're working with the whole firm.
Yep.
So so if you pick me, you're getting my set of experiences there in the room with you, but and we have a lot of mechanisms to make this work. We try to bring the full depth of experience of our entire partnership and everyone, and the entire portfolio network of the Bessemer portfolio companies, just as you're getting with Jeff's great network and with Dave's as well.
So let's take it to you, Jeff. I think Dave's right. From everything we see, you're one of the provocateurs that have really, I think, helped the entire industry see the proof of the model, to see what are the things that you bring to your investments beyond the money, advice, and network.
I think it's basically the same at all levels. The set of challenges that we are geared towards supporting our companies with is how to get from inception, product launch, to clearing the milestones of a Series A, where we can go to Ethan and the other sort of Series A firms and say, hey, this is a deal that we think is actually worthy of a $3, $5, $8 million investment, and this is why we have put our weight and capital behind. So in terms, the VC industry is by definition not scalable. This is relying on a set of individuals who have experience. It takes about 10 years to sort of start knowing a bit what you're doing. And there are models like 500 startups.
Hopefully we know what you're doing.
Hopefully.
Not always.
Like 500 startups, which has a wide mentor network that are proxies of the firm as well. But at the end of the day, what we try to do is to put this infrastructure in place that supports the companies. Yeah. And the difference between firm A and firm B is how good you are at really sort of pushing, helping, kicking, a company over the line of the next round. And as Ethan invests in a Series A, then we'll still support the company, but we'll be secondary to their help because they have a much bigger network and they have more resources. Because with our small funds, management fees don't allow us to really sort of spend a ton of money around infrastructure.
Okay, and Google Ventures has 3 full-time statistic PhDs that did some analysis on venture funding. They found that you actually need, in the seed stage where you operate a lot, and Dave, I know you do as well, you need to do 60 to 80 deals a year to optimize for seed stage investments to earn a mean return of 25%, kind of validating what people have pejoratively said of Ron Conway's strategy of spray and pray. And then I know Andreessen Horowitz.
I actually disagree, but.
What's that? Well, Andreessen Horowitz said they look at about 1,500 investments, make 600 demos to brands and deal makers. So what kind of seed volume do you do by month and year? And go ahead and disagree.
I think it really depends as to.
Disagree with the PhDs.
My pleasure. The point is, it depends as to how good your deal flow is and how complete it is. So if you're Ron Conway, you can assume that you see 99.5% of the deal flow, and therefore you can make, hopefully, the right decision. We're very comfortable with our strategy of doing 20 to 25 investments a year, only.
Which was unheard of.
When I started back in 2007, and I said, we're going to do 20 investments a year, people went, you're crazy.
Yeah.
And then 3 years later, he comes along and it's 200. And it's a different strategy, and we're very comfortable with our 20 to 25, where we basically say no 99.6% of the time.
Right. How about you, Dave?
Sorry. Is this working okay? I think, if you're doing early stage investing, and by that typically I mean pre-Series A and probably pre-product market fit, then you're destined to invest in a lot of failure. And the earlier you invest, the higher number of sample size you should probably be aiming for in order to get some level of success. So We're doing about 200 investments per fund. That might be too many. We might be able to discover enough winners on a smaller number, but at the moment, this is a strange statement. We're being conservative by aiming for about 200 investments per fund, with the assumption that maybe about 20% of them result in some positive outcome, maybe 5% result in larger outcomes that are 20x or better. But I think that just doing a certain number of investments per year is not going to predict for success. You still need to be able to, as Jeff said, have decent deal flow in the inbound, have decent selection.
Let's use that mic.
Have decent inbound on the quality level and on the selection. And probably more importantly, on your follow-on investment, you have to sort of make intelligent decisions, at least at the second check. As far as we're doing, that would be probably seed and Series A, and then hopefully have some strong conviction at Series B or the larger investments. We might only be writing $250,000 to $1 million check when someone like Jeff is writing $2 million or $3 million, and Ethan might be writing a $10 million or more check. But we're still trying to make money more on the second and third checks, not on the first one. We're just doing discovery and analysis on that first check.
I just point out it's really hard to apply portfolio theory, which I haven't seen the study that Google Ventures did, but it's hard to apply a kind of asset model to venture capital because the vast majority of companies are not going to be big home runs and are not going to yield the kinds of returns that are going to drive funds of the type that we're raising. And so it turns out that picking among the very small number of winners that you see among startups is really all it comes down to. Any model you were to build for this is going to be incredibly sensitive to which particular investments among the 10 out of thousands of companies you pick. And so you could optimize for that, but it strikes me that that's a really hard, it's really hard to predict it.
But Ethan, do you think that by having better due diligence on the front end, you're going to have any better success with a smaller sample size? Like I agree with what you're saying, but I think even if you agree with Peter Law's power law, sort of thesis that you can't really be successful with a small sample size strategy unless you're good at detection early. And I don't think anybody's really good at detection early. And I challenge anybody to say that.
I think the head of Google
especially when
it's like Lake Wobegon, where everybody thinks their children are above average. This idea of being.
No, in this case, you think your children are not just above average. You think they're like 7'6" and dunk on everybody else in the fucking class.
Right.
That's.
And then maybe you've got a shot.
But you're picking the 7'6" person when they're like 8 years old.
When they're in the womb.
Well, I think that the difference between us and a fund like Bessemer is that we basically have one shot, maybe two, at goal. Where we're going to look at the company as it's raising its seed round, and maybe if we pass, maybe we have a shot at the Series A, but then we're done. As far as you guys are concerned, you passed twice on LinkedIn, but you got them the third time, and you paid up.
That's right.
But that's true. I mean, they invested and they made a couple of money on that. Whereas I passed, and it's gone. And so that's sort of the challenge for us is to figure out in a very limited sample of data we can use whether something is sort of worth our investment or not, or worth being 1 over 20 slots a year, and that's very difficult.
I think you need to really, what I was really pointing out was that the investment world is segmenting into pre-traction investing and post-traction investing. You're either early and contrarian or you're late and right. So Ethan's not going to make a large number of bets. He better be fucking right with the big-ass $10 million check. So he's probably looking for post-traction evidence and trying to assess whether that team and that product and that market can get another 10x after traction, and then try to make sure they can get into the deal, right? Whereas a lot of us, I don't know where Jeff feels he is on this side of the equation, a lot of us are like, hey, we can't really tell whether there's traction or not. We think you're smart. We think this product has a chance. We think your opportunity in the market is decent, and we're going to make a bet before traction, and then we'll double down if we're right, but we're probably going to be wrong 4 out of 5 times.
No, I think that's exactly right, and I think to the extent people talk about this venture dislocation or this change that happened, it's as a result of putting too much money into companies pre-traction. And it's like you're torn to it all the time. You meet great entrepreneurs, as this is speaking personally here, I meet great entrepreneurs all the time and want to invest behind them, but as the math is the math on it, most of those companies will not achieve a state where it makes sense to put the kind of venture dollars that we're looking to put into an investment.
Yeah, let me
And so
shift.
you can get pulled earlier, and that's what created a lot of the dislocation.
Let me shift to a little bit about what we're doing here. We're in Vancouver here, and the international market, and I know that Andreessen Horowitz, again, just using them because they're not here, but again, someone that's setting a standard on a lot of stuff, says they're not going to be doing international. At your Unsexy conference a week or so.
Andreessen's done some international. They've done Vicky with us out of Singapore.
Yep, but it's not a focused strategy, whereas
No.
you talk very differently about international. We heard that MailChimp's doing 60% of its business. I could tell you from the CPG world, everybody's looking to BRIC countries for their growth. What are you guys thinking about in terms of international? How are you doing international? There's this valley-centric sort of nature. We're kind of getting out of it here in Vancouver, I think, for the folks in the audience. What's the evolution of venture when it comes to international?
I don't know. I guess I can start. I mean, I think it's crazy to overlook international. I mean, we've embraced it from the beginning, and we have offices in India and Israel, and we just opened Brazil and Russia. But you just look at the data on where disruptive technologies come from, and it's not always Silicon Valley. There's a lot of companies here. You mentioned some others. All our companies are seeing traction internationally and opening up offices there. And so some of our best investments have been in places even where we don't have offices or we're flying into. And so, yeah, I think we are going to see more and more of that. There's a challenge to it, though, in that if you don't spend the time to understand the local just signs and signals that we use as part of our diligence, it can be very hard and discomforting to do so.
Yeah.
So it takes a focused commitment, but I don't think it's something that's worth overlooking.
Yeah, I completely agree with that statement, and that's why we've decided not to invest outside of the markets that we understand. And so we completely recognize that there is a big opportunity, especially in e-commerce, in Brazil and Turkey, but we just don't know those markets, and therefore all the value add that we typically deliver to our companies would not be able to sort of do so in those markets, so we don't invest in those. Our companies do go abroad and invest internationally and so on and so forth, so it's a different ballgame. I think when it comes to Canada, the difference between now and 3 years ago when we had the first Grow conference is that you guys finally dropped Section 116, and therefore the barrier for investments to flow out of Canada once we have realized something, is no more. And so we can actually invest in Canada as if it was sort of a province of sorts of Silicon Valley, and we're happy to do so. We have Vidyard in Waterloo, and we have Top Hat Monocle in Toronto. By the way, they both are hiring, right? So if ever you're looking for great jobs in companies,
Bringing that value.
go there.
There's that venture value.
And we will definitely consider, Canadian companies very openly.
Yeah, Dave?
I think that you should invest in what you know, and if you think international is important, you should get really damn good at understanding what's going on in those markets and segments. So our first fund, the strategy is probably 60-30-10, Silicon Valley, rest of US, rest of world. This fund, it's probably 50-25-25. That said, we've done about 50 or 60 investments outside the US right now, and we've done investments in, I think, all six continents that aren't Antarctica, and at least 20 countries. But focus for us is probably going to be at least, in the next 12, 24, 36 months, probably Brazil, Mexico, India. I mean, we've done a lot of stuff in other places, but those are large markets, not tremendously overheated, although India and Brazil have their moments, certainly at Series B. But I think the reason that we're also doing this is because there are certain advantages being a Silicon Valley investor and being an international investor, and most people don't understand that. So, the back-end platforms that drive growth for most consumer and small business services are probably outside of China and Russia. Google for search, Facebook and Twitter for social, Apple and Android for mobile, maybe throw in YouTube on video, maybe now Pinterest and a few others. So there's like 5 to 7 sort of significant platforms, hundreds of millions of users that drive substantial adoption on search, social, mobile, and a few other areas. Now, where are all those platforms located? Well, with the exception of a few companies that are located in about a 15 to 20 mile radius of San Mateo, California.
Yep.
So being a Silicon Valley investor, you have the potential advantage, if you want, to establish significant relationships with those platform companies and hopefully convey some of that either through introductions, through learning, or through other methods on the rest of your portfolio.
Yep.
And so finish the thought on that is, okay, those platforms are the same. Every fucking place around the world, they're the same, except for, maybe China and Russia. So, you're actually not leveraging the investment opportunity by your proximity to those platforms. So if you go to Mexico, if you go to Brazil, if you go to India, they still need access to Google, Facebook, Twitter, LinkedIn, YouTube, whatever. And so your ability to bring that connection to them is a tremendous advantage relative to local market investors.
I would point that, so we have a couple of companies in Europe, and one of them is marketing it's Blink Booking, marketing a service in Spain, Italy, France, UK, and Germany. And the arsenal that they have to use in order to get users, so download the applications, is completely different from one country to the next. In one country, it's going to be PR. In another country, you're going to buy, downloads from a given service, which happens to be, local. And so, yes, you have a set of platforms which can be used, holistically across geographies, but there are levers to play because they don't all work the same. And therefore, it's not like a cookie cutter model you can replicate across, geographies that you can apply.
And just like one other point to that, like you have to invest in resources on the ground. I don't think you can just like drop in, fly by, and like make investments in those countries.
But you could do a hub and spoke approach where you still keep your core.
Right, but I mean, like we have a woman who's Chinese and Brazilian on staff. We have 2 folks who are Mexican. We're hiring someone who's Indian next month. Like we're making investments in those countries with local market sort of people and who understand the language and the culture and the geography. And like, if you think you're going to figure that out by just like dropping in for a couple weeks, like that's not likely.
I think what you're hearing is the opportunities are there. It's just an organizational question for each individual group as to how to prosecute.
Sure.
And a focus on a strategy.
Right.
Sure. So when you guys think about, venture has made a living investing in innovation and largely hasn't until recently had to do a lot of innovation themselves. However, we're starting to see more and more VCs use all the social tools well. Dave's a prolific blogger. You're on steroids when it comes to Twitter and other platforms. I know you're certainly very active as well. We've got what tools are you using to scale? You talked about Angel.co on your post, Dave. What other tools are you guys using? Are they proprietary? Are they cloud-based? What are the things that you're using to scale up your business, specifically in venture to apply to growth?
You're right. It's sort of, there's a certain irony in that the industry that looks to invest in innovation has been one of the slower industries to innovate. I'd agree with that. But I think kind of beneath the surface, there is a lot of disruption, a lot of, just in the past sort of year or two with some of the trends that we've talked about, there's a lot of, sort of catch up going on. So as far as what tools we use, I think it's a lot of the same ones you mentioned. What we've had a lot of luck with is bringing on people with specific expertise and building content and programs around them. So we brought on 2 years ago Jason Patorti, who was a designer of Mint, to be a designer in residence and kind of evangelize the power of design publicly to any startup that wanted to listen. We provided that kind of as a service to everybody, and that helped us with sort of test out ultimately a correct theory we had around the best way to build consumer web experiences. It's around the user experience and design.
That's great.
As far as social media, you mentioned all the tools. I think firms are still figuring that out. We've been late to the party on some of it and early on some other things in terms of, we're trying to use Pinterest as a lead gen tool now. We'll see if that works. I don't know.
Yeah.
I think, VC is such a small market that we actually don't have the tools we need to leap ahead in the future. So most firms are still using spreadsheets, to manage their deal flow. Then, the most advanced ones are using Salesforce.
Yeah.
And I think,
or not using it effectively.
when it comes to sort of using social media tools, this is something that as practitioners, we have to understand. So we are using the products that we're investing in. And I think one of the fundamental tools we've been using as sort of the outsiders of the investment industry has been social media, because it gave us a voice and a way to sort of distribute our know-how and the way we were sort of doing things and take our investment strategies and push them out, especially at the beginning, in a very sort of useful way. And I have no doubt that the blogs we had early on sort of helped us become way more well-known than we deserved at that time.
One tool that's sort of underappreciated for its impact on venture capital specifically is LinkedIn. It's incredible. The wealth of information.
Are you an investor?
We were investors in LinkedIn. I'm just speaking as a user. We did invest, as Jeff said, finally, after making a mistake before.
No, you invested, dude.
Yeah, we were in. We were in.
I passed.
It is.
We're good.
Yeah.
Hurts.
I had the same problem with Twilio, actually. Finally invested. You can get a remarkable amount of data out of LinkedIn as to, a read on a person, a read on a product, a technical act. I mean, you know how to use LinkedIn. I don't need to give a primer here, but that's been a big leap forward for our industry.
Cool, Dave. I know you're on steroids with some of these.
I think the primary innovation that's really been happening in the last 2 years has been AngelList. That's really been driving a significant amount of change in how people look at deal flow, not just in the Valley, but all over the world. And most people don't quite understand, like, that's not just an individual tool, it's actually a platform and an API for getting that data. So we've actually built integration with AngelList and with several other platforms, LinkedIn and others, to pull in data.
Put something over the top to actually funnel, manage?
So we've built an internal dashboard tool that we use for communications with our portfolio and with mentors. We're starting to
They have an
add
open API, AngelList? Can you pull data out of it?
Yep, absolutely. And so being able to use that as a way to kind of mash up information for your own analysis, both before you're doing selection and possibly after.
And I know you push your startups to do the same thing. Get on angel.co and make sure you're known.
Yeah, but I mean, I think that's really just sort of the tip of the iceberg, tip of the mountain. Yeah. I think, really, so the comment before about investing in non-investment staff is really, so again, if you're pre-product focused, trying to understand how you can be helpful in design, marketing, engineering, the things that are actually sort of useful in hopefully getting to a level of traction that's interesting at Series A or level of usage and monetization. So we've made investments in running our own conferences around design, around marketing, around monetization. We really feel strongly that those types of efforts and disciplines, we're probably closer to some type of school than we are some type of VC and how we're trying to build that out. Not like we're the best at that yet, but I would say, in the long run, I'm probably more focused on competing with business schools than I am with later stage venture, and I'm pretty sure I'm going to fucking crush business schools because they charge $100,000 for people to attend, and they tell people to read business case studies. And we give them $100,000, and we have them, don't read the fucking case study, build the case study.
There's an industry that really has not evolved.
They want us out.
Yeah.
Hey, do we have time for a question from the audience? Anybody have a question for this esteemed panel?
They're saying no.
Good, you're nervous? Good, all right. If you like these speakers, thank them by following them on Twitter, and join me in thanking them now with a big hand.